On December 31st, silver didn't sell off. Silver got yanked. 11% in 47 minutes. No headline, no warning, just a clean, vertical drop from the mid-70s into the mid-60s, like someone cut a cable and the elevator fell. And if you looked at that chart and felt your stomach flip, good. That reaction is normal. Because what happened wasn't about silver the metal. It was about the machinery that pretends to price silver. I'm your host, and you're watching our channel. Let's get straight to the real event. Here's the uncomfortable truth. The plumbing seized up. The pipes that connect paper sellers to real buyers clogged, and pressure found the weakest joint. The joint was the futures book. The metal didn't change. The system did. Fact: price dropped roughly 11% in under an hour. Interpretation: that wasn't the market deciding. That was a forced unwind. Now watch this. The physical world barely blinked. Premiums didn't collapse the way spot did. Fabricators didn't cancel orders. Dealers didn't suddenly become desperate to buy your coins back. If anything, the phone lines got hotter. Because smart money smells a mechanical event like smoke. So what actually happened? It was a year-end balance sheet flush. The kind of thing that never gets explained on TV because it's boring, technical, and it exposes how fragile the paper layer really is. But for us, this is not boring. This is the edge. Every December, large institutions face the same problem. They have to look clean when the calendar flips. Regulators, internal risk committees, auditors, all of them show up like inspectors at a restaurant. Ratios, exposure limits, derivative reporting, capital charges. If your book looks messy, you don't get to argue the thesis. You reduce it. Period. And late December that year, silver had become a messy line item. Not because the world stopped wanting silver, not because mines suddenly doubled output, but because paper exposure had grown too big relative to the metal that can actually be delivered. This is the part most people miss, so let's keep it simple and sharp. A futures contract is a promise. It's a claim on metal, not metal itself. Claims can multiply like receipts at a casino. The casino looks fine until too many people walk to the cage at the same time. When silver pushed toward the mid-70s, some desks were sitting on short exposure that started to look toxic on year-end reports. Mark-to-market losses are not opinions. They are numbers that land on a balance sheet like a brick. So risk managers did what risk managers always do. They pulled the lever. Not a gentle exit, not a patient unwind, a mechanical dump. And the timing mattered. It was New Year's Eve. Liquidity was thin. The big market makers were half-staffed. The order book was a shallow pool, and someone backed a truck into it. Sell orders hit in rapid sequence. Contracts got liquidated. Stops got triggered. Margins tightened. The system did what it's designed to do when leverage gets too heavy. It forces selling into the abyss. Here's where we separate facts from interpretation again. Fact: massive selling hit the paper market during a low liquidity window. Interpretation: someone was more afraid of how their book would look at midnight than they were confident in the trade. And that is not a silver story. That is a balance sheet story. Now here's the twist that should make you sit up. The physical market didn't follow. Because physical buyers don't buy charts, they buy atoms. They have production schedules, contracts, supply chains, and penalties if they can't deliver product. They don't care that a futures candle turned red. If they need metal, they need metal. So when the paper price got smashed, the physical desks saw a temporary coupon. But it wasn't a free coupon. The spot quote fell harder than real-world pricing did, because physical always trades with friction. Premiums, transport, refining, inventory constraints. That friction is the truth. Paper can reprice in seconds. Physical reprices when humans move inventory. So while the chart screamed panic, the real market whispered opportunity. Do you see the difference? This is why people who only watch the ticker keep getting emotionally whiplashed. They're staring at the puppet show, not the puppeteer. Let's talk about the chain reaction, because this is where the system reveals itself. First, the short exposure looked ugly on year-end statements. Second, compliance and risk limits didn't negotiate. They demanded position reduction. Third, the easiest place to reduce size fast is the futures market. Not because it's honest, because it's liquid and centralized. Fourth, the dump hits when the order book is thin, so the price gaps down violently. Fifth, the selling triggers more selling. Not because more people decided silver is worthless, but because leverage has tripwires, stops, margins, auto liquidations, algorithms that don't feel fear but obey rules. And sixth, this is the part that matters for us. Physical buyers step in, not to trade the bounce, but to secure inventory. They're not trying to win the day, they're trying to avoid being the factory that can't ship product. So who lost? The forced sellers lost. If you're forced to sell, you don't choose the price. The market chooses it for you, and it's usually the worst possible moment. Who won? The buyers who had dry powder, conviction, and access to physical supply. And there's a third group, the most dangerous group, the people who misread it. They saw the drop and concluded, silver is weak. They sold their long-term position at the exact moment the mechanical pressure peaked. They handed metal to stronger hands and then watched price stabilize like nothing happened. That's how markets transfer wealth, not with a conspiracy speech, with a margin call. Now, let's pause in the same room together for a second. If a market can drop 11% in 47 minutes with no headline, what does that tell us about price discovery? Is the price discovering reality, or is it reflecting whoever has to hit the sell button right now? That question is not academic. It's the whole game. Here's the mistake most people make. They assume price equals truth. In calm times, price is a decent approximation. In stress, price is a vote. And the most leveraged voter screams the loudest. We're not gambling. We're measuring. So let's measure what didn't change that night. Did global silver demand collapse in 47 minutes? No. Did industrial usage vanish? No. Did physical inventory suddenly overflow? No. So what changed? Positioning. The paper layer shed leverage. The physical layer absorbed metal. And that transfer matters because it changes who controls the next move. In markets, the next move often belongs to whoever owns the optionality. Optionality is the ability to wait. If you're levered, you can't wait. Time is your enemy. A small move against you becomes a forced decision. If you're unlevered and positioned correctly, time is your ally. Volatility becomes a sale, not a threat. That New Year's Eve drop was the market screaming one thing: leverage is fragile. Now let's connect this to the bigger tension that had been building, because the flush didn't come out of nowhere. For months leading into that day, the physical market showed strain. Delivery windows stretched, certain products got tight, premiums stayed stubborn even when spot wobbled. That's not sentiment. That's inventory telling you a story. Meanwhile, the paper market kept stacking claims. Open interest remained heavy. More promises on a foundation that wasn't getting thicker. That's like building extra floors on a building while the concrete cures slower and slower. It looks stable until it doesn't. And the doesn't moment often happens when liquidity disappears. Holiday sessions, overnight hours, thin windows where a big order can move price like a crowbar. So when the dump hit, it exposed the split-screen reality. Paper price can plunge. Physical value can hold. That split is a warning. Because when paper and physical diverge too often, confidence breaks. And confidence is the hidden collateral behind every derivative. If you don't believe the paper reflects the metal, you stop using paper as your anchor. You negotiate physical. You demand allocation. You pay a premium if you have to, because you're not buying the quote. You're buying certainty. That's how bifurcation begins. Two prices, two markets, two realities. And when that happens, the people who only trade the paper chart get trapped in a game where the rules change mid-hand. Now, I'm going to say something that will make some people uncomfortable. The drop was a stress test, and the system failed it. Not failed in the sense that the market broke forever, failed in the sense that it revealed a structural weakness. The price can be pushed around by balance sheet needs, not supply and demand. That means we need a better framework than "it went down, so it's bearish." Here's our framework. We separate mechanics from fundamentals. Mechanics are short-term forces: margin, liquidity, regulatory windows, stop runs, dealer gamma, rebalancing flows. Mechanics can move price violently. Fundamentals are the slow forces: production, consumption, inventory, substitution, recycling, capex cycles. Fundamentals move value. That night, mechanics overwhelmed price. Fundamentals didn't flinch. So what do we do with that? We don't pretend we can predict every candle. We build positioning that survives the machinery. We ask the smart questions. If spot is down, why are premiums flat? If the chart screams panic, why are physical buyers still bidding? If the market sold off, why didn't inventory flood into dealers? Those questions don't make you popular on social media, but they keep you alive in real markets. Now, you might be thinking, okay, fine, it was a mechanical flush. So what? So what is everything, because the flush changes the cast. The desks that were short and pressured got lighter. Some got tapped out. Some reduced exposure. Some closed. That means the constant overhead supply from defensive shorting can weaken. And the buyers who stepped in during the dislocation, they didn't buy for a week. They bought for a cycle. That shifts the market from fragile to supported. Not supported by vibes, supported by ownership. A market held by weak hands can fall on a whisper. A market held by strong hands can absorb shocks and keep walking. So here's the contradiction that catches people. A violent drop can be bullish, not because drops are good, but because a drop that removes forced sellers and transfers metal to patient holders can set a firmer base. That's why the recovery matters. The rebound wasn't magic. It was the system snapping back once the dump stopped and real buyers reasserted themselves. Now we need to talk about risk, because this is educational, and we manage risk. This is not financial advice. This is a framework for thinking, not a promise of profit. And here's the risk most people ignore. The paper layer can do this again. Maybe not with the exact same trigger, but the mechanism exists. Quarter-end rebalancing, margin hikes, a sudden dollar spike, a risk-off stampede, a geopolitical headline that causes funds to de-risk. Any of these can force paper selling that has nothing to do with the metal. So the question isn't, will there be volatility? The question is, will volatility force us to act against our plan? If the answer is yes, we're positioned wrong. If the answer is no, volatility becomes noise. Now, let's get tactical without getting sloppy. We don't need 20 takeaways. We need a few that matter. First takeaway. That drop was not a referendum on silver's usefulness. It was a referendum on leverage. The weak link snapped. Second takeaway. Paper price is not the same as physical value. When they diverge, trust erodes and bifurcation accelerates. Third takeaway. The winners are the participants who can operate in physical reality, secure allocation, hold inventory, and wait. That's where structural advantage lives. Fourth takeaway. The next move will be driven by positioning and confidence, not by what the chart deserves. And fifth takeaway, the one most people will miss, is that events like this teach the market. After a public mechanical flush, participants adapt. They tighten risk. They demand better terms. They stop taking the paper quote at face value. In other words, the system becomes less stable because everyone becomes more defensive. Now, let's bring this back to you. If you're watching silver, you're not watching a tech stock. You're watching a market where paper claims and physical constraints can collide. When they collide, the move is fast, ugly, and confusing. That's why we keep our language precise. Certain, the price dropped fast during a thin window. Likely, year-end balance sheet pressure amplified forced selling. Possible, some desks use the thin liquidity to run stops and improve their own execution. We don't need fake confidence. We need a map. And the map says this: the paper market is a lever. Levers can lift, and levers can crush. But levers don't create metal. So where does that leave us going forward? It leaves us watching the signals that matter. Not just spot, not just headlines. We watch premiums. We watch delivery times. We watch inventory data where we can get it. We watch open interest. We watch how price behaves in Asia versus New York. We watch whether dips get bought quickly and whether rallies get capped aggressively. Because those behaviors reveal who's still trapped and who's in control. And there's one more signal that's easy to miss: narrative. After a flush like that, the messaging usually shifts. You'll hear, silver is volatile, silver is risky, silver is a trader's market. That narrative is designed to make you think the move was natural. But the move wasn't natural. It was mechanical. When you confuse the two, you become the liquidity. Now, I want you to answer this in the comments, because it tells me how our community is thinking. Did you watch that 47-minute drop live? Or did you only see it after the fact? And second question, do you trust the paper price as the real price? Or do you think physical reality is already pulling away? Drop your answer below. We read them. And let's stress test our own thinking, because that's how we stay credible. If we're wrong, where will it show first? It won't show up in a spicy headline. It will show up in the boring stuff. Premiums collapsing, delivery times shrinking, refiners offering discounts, inventories building without incentives. That would mean physical stress is easing. But if we're right, the first sign won't be a moonshot candle either. It will be a stubborn spread. Spot dips and premiums refuse. Paper sells and physical shrugs. That's the tell that the quote is becoming a reference, not a reality. Think of it like a dam. The chart is the water level you can see. Physical tightness is the pressure you can't. A sudden flush can drop the visible level, but if pressure is still rising behind the wall, the next release is bigger. So we don't chase. We monitor. We stay liquid in our decision-making, not leveraged in our positions. And when the dam finally cracks, it won't ask our permission. It will move fast and punish hesitation hard. Now here's the part you really need to hear, and it's where most videos would slow down and summarize. We're not doing that. We're going to push forward. Because the most important consequence of that day is still unfolding. The market learned that it can snap. And when a market learns it can snap, everyone starts building shock absorbers. Dealers widen spreads. Funds reduce leverage. Industrial buyers lock contracts earlier. Producers negotiate harder. Everyone adds friction. More friction means less liquidity. Less liquidity means the next mechanical move can be worse. That's the paradox. The system stabilizes by becoming more brittle. So we should not be surprised if the next dislocation is sharper, faster, and even less connected to any headline. And that leads to the question that matters for the next chapter. What happens when the next forced selling event hits? And this time, physical buyers don't just absorb it quietly. What happens if they decide to front-run it? What happens if they start treating paper dips as scheduled inventory auctions, and they show up with bigger checkbooks? Because if that starts, the paper market doesn't just decouple, it gets hunted. That's when candles stop being volatility and start being signals of a regime change. So here's our plan as a community. We stay skeptical of the ticker when it moves with no story. We separate mechanics from fundamentals. We don't let leverage force our hand. And we keep watching the physical heartbeat, because that's where the truth lives when the screen lies. If you want more of this kind of breakdown, not hype, not clickbait, just the machinery explained, subscribe. Short and simple, subscribe and stay with us. Because the next time silver moves like that, it won't be on a holiday when nobody's looking. It'll be in the middle of a normal week with everyone watching, and the reaction will be different. And when that happens, the question won't be, why did silver drop? The question will be, who just lost control of the lever? That's the chapter we're about to enter.